With the numerous decreases of the interest rate by the Bank of Canada in 2024 and with the ones that are forecast for 2025, Canadian dividend companies that are well known to be financed a lot by debt will become more and more interesting in the near future. It is why in this video, I'll share with you what I personally believe to be the 3 best Canadian dividend stocks to have in your watch list for 2025. Starting out with one of the largest energy companies in the entire world, which is Enbridge with the ticker ENB. Over the past couple of decades, Enbridge has been a fan favorite of many Canadians and a lot of different fund managers, and this trend isn't set to reverse in 2025 by moving about 30% of the total crude oil that is produced in North America, transporting nearly 20% of the natural gas consumed in the US, and operating North America's largest natural gas utility by volume. Enbridge has become, over the age, one of the most important businesses for the Canadian economy, while over the past couple of days and weeks, we've seen that the president-elect of the United States, Donald Trump, has said that Canada's products and services were not that much important for the US. It is important to understand that our southern neighbor are currently importing over 52% of their oil from Canada, which is the equivalent of 4.42 million barrels import per day. On their part, Enbridge currently accounts for about 65% of all the US-bound Canadian exports and 40% of all the crude oil that is imported in the United States. So even if Donald Trump has said that he wants to
drill, baby, drill,
we can see that at the moment, the US are still massively dependent on Canada's natural gas and oil. But that's not all. What helps Enbridge to continue to grow year after year is by making new acquisitions to increase the field of their operations. More recently, Enbridge has notably made an acquisition where they've acquired a trio of US companies from Dominion Energy, helping them to become North America's largest natural gas utility company. These types of acquisitions have the objective to increase the total production and the storage of this company, but at the same time, it also increased their total financial strength. Indeed, in their latest earnings report, we've seen that the company has been able to increase their adjusted EBITDA year over year by over 8%, which were partially driven by an incredible increase of 92% in their gas distribution and storage. By keeping their costs and expenses relatively low, this has also helped them to increase their distributed cash flow year over year by about 1%. This distributed cash flow increase is particularly interesting and important for a company like Enbridge that is considered as a dividend aristocrat, where it has been increasing their dividend for the past 29 years and where they've been able to increase their dividends for that same period with an average annual growth rate of over 10%. In terms of the valuation of this company, over the past year, we can see that it has been able to increase by over 20%. As you've been able to understand, Enbridge is a quite important actor in the natural gas and crude oil field that is pretty essential to our lives to, for example, fuel our cars and our houses. But one of the other aspects of this company that is quite important is that Enbridge has already started years ago to adapt its business model to tomorrow's environment. To do so, they've been adding important renewable energy projects to their business model, such as wind farms and solar panels. And so, even if this business segment is still quite smaller compared to the other ones of this company, Enbridge is still able at the moment to produce enough electricity to meet the energy requirements of about 1.3 million homes across the country, which is also why I personally believe that Enbridge is one of the best Canadian dividend stocks to have on your watch list for 2025. Now, for the second stock on this list, we'll dive deep down into another crucial market in Canada, which is the banking sector. Indeed, if you know well the Canadian economy, you must know that it is both filled with great energy companies as well as great solid financial companies. It is why, on that regard, I've decided to include on this list the Toronto Dominion Bank with the ticker TD. As being a member of the Big Five Canadian banks, which include companies such as RBC, CIBC, BNS, and BMO, TD, unlike some of its competitors, has been on a bad negative downtrend over the past couple of years. With the termination of the acquisition of the First Horizon Bank in 2023, combined with the money laundering allegation that have been made in 2024, it is fair to say that this Canadian bank has been facing quite a lot of adversity over the past 2 years. This has also been well reflected in their total valuation, where we can see that the company's value is still far from its all-time high that has been reached in 2022. But just like Enbridge, this Canadian bank could greatly benefit from the numerous decrease of the interest rate that have been made by the Bank of Canada in 2024 and with the ones that have been forecast for the next year. In fact, it is still not clear for many people how banks are able to generate that much money year after year. Many think that they are generating the largest part of their income from the sales and the fees that they are charging their different customers for their products and their services. But that's not all. One of the reasons why banks are able to generate a lot of income year after year is with what is called the interest rate spread. This comes from the difference between the interest that are paid by the bank and the interest that are earned by it. And so the difference between both of these makes their total profit. To put it as simple as possible, let's say that banks are lending money to people looking to buy houses. In that case, banks will be earning a certain percentage on the total loans value. It can be on a variable or a fixed rate. But on their side, banks also offer different financial products to their customers, such as gigs. So this makes it by far one of the most important income sources of banks, especially for a company like TD that currently has over hundreds of billions of dollars under its management. When we take a look at their latest earnings report, we can notice that TD has been able to increase their quarterly revenue by an incredible 18% year over year. This was partially due to a $718 million of reinsurance recoveries for catastrophe claims, where we can unfortunately see that their insurance service expense have been exploding by 76% year over year. With the series of hikes of interest rate that we've seen between 2022 and 2023, this has also unfortunately impacted the capacity of different borrowers to pay their loan. This is why by increasing the credit default risk, we've seen that TD has been increasing their provision for credit losses in the last quarter by about 26% year over year. This provision is a provision made by the bank for the potential amount of money that they'll lose in the future for the default risk. Nevertheless, even if their total expenses have been increasing by about 6% over the past year, we can notice that their total net income on their side have been massively up by more than 27%. So despite all the negative news that TD has been facing lately, they remain a quite financially strong company. But at the end of the day, these news have obviously been impacting the current value of this business, where this could represent a great opportunity for you. And what makes it also pretty interesting is for the dividend income investors looking for a stable company with a beta of less than 1, combined with an excellent 5% dividend yield that has been increasing over the past 10 years. Finally, third and last on my list is the telecommunication company Telus with the ticker T. While the telecommunication sector over the past 2 years has been by far the worst performing market, where we've seen a company like Bell that has been totally destroyed, Telus by far, in my opinion, represents the most interesting telecom companies in the market. At the moment, what helped this company to distinguish themselves compared to their big competitors such as Bell is their financial strength that they have. This has made that over the past year, while both Rogers and Bell have been losing a lot of value, Telus has been able to slightly resist better to this downtrend momentum. What is also interesting about Telus' business model is that they are not only offering different television, internet, and cell phone services, but they also offer a wide range of other products and services such as well-being and health solutions. All of these products and services in their latest earnings report have helped them to increase massively their total net income by over 87%, up to $257 million for the quarter. However, one of the negative news that have been impacting the value of telecom companies in Canada lately has been the CRTC decision made in 2023. Indeed, 2 years ago, the CRTC, which is a Canadian regulatory agency mandate for controlling the broadcasting and the telecommunication in the country, has decided to increase choice and affordability of high-speed internet services for more than 5 million Canadian households. This doesn't represent some great news for the big Canadian telecom companies, which is a market that is basically divided between three big companies, which are Bell, Telus, and Rogers. It is why the control of the price limit has been one of the main reasons why we've seen the telecom market collapse over the past 2 years. For the companies themselves, this has had the impact that they have decided to stop investing as much in their infrastructure and in the growth of it, notably with the 5G network. And this has also resulted in the massive reduction of their total workforce over the past year. In the case of Telus, in their latest earnings report, we've seen that they've cut their total capex by about 13% year over year, which has driven up their free cash flow progression that has been jumping by an incredible 58% up to $561 million in the last quarter. So despite all the negative economic conditions that we've seen on the market lately, Telus has been by far the best telecom companies of these past 2 years. Add to this, in my personal opinion, the recent downtrend momentum that these companies have been facing could represent great entry door for different dividend income investors, especially with the numerous decrease of the policy rate made by the BOC over the past year, which should have a great impact on the total profitability of these companies. Plus, with some competitive price to earnings and forward price to earnings ratios that have been diminishing over the past couple of quarters, combined with solid price to sales and price to book ratios, this 8% dividend company could definitely be a great pick to add to your watch list. So there you have it. Those were 3 of the most promising Canadian dividend stocks for the next year to come. However, if you are looking for more stability in your portfolio, another interesting option for you could be to invest in great exchange trade funds. In that case, if you're looking for the most promising Canadian ETFs for 2025, check out the video that's gonna be right over here, and I will see you soon. Peace.